Today, rental growth hits a ceiling. Hello again, it's Martin North from Digital Finance Analytics, one of the latest posts covering finance and property news. Just before I start, a big thank you. We've just reached 70,000 subscribers on YouTube. Really appreciate your support. If you haven't subscribed, please do so. I'd like to get to 100,000 as soon as I can. Now, the REA Group just published the PropTrack Rental Price Data to December 2024 quarter. They say that national median advertised rents increased by 1.6% over the December 2024 quarter. That's to a new high of $620. But note, this is the asking price of new rentals and does not cover rental increases on existing property where the tenants have to pay more or leave. The capital city advertised rents increased 1.6% over the quarter to $640 per week, as all markets saw unchanged rent prices except Brisbane and the ACT. National rents increased 6.9% over 2024, down from 11.5% over 2023. This marked the slowest rate of annual rent growth since the September 2021 quarter. Advertised rents in Sydney were $730 and Melbourne were $570 a week, and they've remained flat for the last 6 months. House rents increased 1.6% in the December 2024 quarter, while unit rents were unchanged. However, over the past year, units were up 7.1%, growing slightly stronger than houses, which were up 5.9%. In regional areas, advertised rents were unchanged at $550 per week in the December 2024 quarter, but increased a significant 10% over 2024. The pace of rent growth across the country is slowing, with market conditions easing for renters, they said. Rents are now growing at their slowest pace since late 2021. The slowing pace of growth comes on the back of an increase in the number of available rentals, as well as the cost of living pressures limiting tenants' spending capacity. In welcome news for renters, in the two largest rental markets, Sydney and Melbourne, rents have now been unchanged for 6 months. Brisbane and Canberra, with only two capital cities to see rents increase over the past 3 months, but Adelaide and Perth have seen the strongest increase in rents over the past year. January marks the busiest time of year for the rental market, they say, with tenants out in large numbers looking for new rental homes. So they expect rents to increase moderately this year, with a trend of slower rents to persist through 2025. So, in fact, after capital city asking rents soared by more than 40% since the pandemic, rent inflation is at least slowing at the headline level. But why, you might well ask? Well, given that around 70% of all those in the rental sector have cash flow pressures, according to my surveys, it is mainly because we have now reached an affordability ceiling. A greater share of households' income is going to pay the rent, according to recent data from CoreLogic and ANU. In addition, some tenants have responded to those conditions by moving into group housing, which has tempered demand, or indeed have moved back with parents. High migration is continuing to mop up rental property, and Australian tenants still face an undersupplied market with historically low rental vacancy rates. Remember that the Centre of Population has projected around 410,000 annual population growth over the next 10 years, roughly equivalent to growing by a Canberra every year, which will ensure that population demand will continue to outstrip supply. Melbourne's population is projected to balloon by 1 million people over the coming decade, and Sydney's by 900,000 people, whereas Brisbane and Perth's population are projected to swell by 500,000 apiece. As a result, Australia's housing shortage will inevitably continue to grow, pushing tenants who are now reaching peak ability to pay. Any re-acceleration of real incomes will tend to lift rentals higher, and meantime, more property investors are realising that their investments are a negative cash flow investment. And incidentally, data from the ABS yesterday showed that rental inflation declined to 6.6% for the year to November 2024, down from a peak of 7.7%. This is, of course, a difference between asking rents for new tenancies and all tenancies, which can make the numbers difficult to reconcile. So don't be deceived. This data, which was reported as good news in some media today, needs to be taken in context. The slowing was predominantly the result of months and months of insidious financial pressure, which is unlikely to stop anytime soon. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.